Hi, and welcome to Algos with Garen, a show dedicated to educating you about the stock market, as well as teaching you how to build auto investing machines that beat traditional dollar cost averaging using a software called Composer. If you're brand new to the channel, go ahead and watch this video to get started learning the basics. In this episode, I'm going to do a community showcase showing you 3 strategies, all of which beat the stock market, 2 of which were made by community members. All 3 of these strategies are back tested to 2014, and the first one is called SPY Minimum Drawdown, made by Claude Constantine. This strategy isn't anything kind of crazy, but what is really unique about it is it has a maximum drawdown of only 13.5%, which is insanely good if you're new to this stuff. And this strategy actually won a $1,000 contest. The second strategy is called TQQQ for the long term version 2 by Derek Nicholson, a Reddit user. Now this strategy is insane. It has a 293% annualized return, but it does have a max drawdown of 46%, which isn't the greatest. Regardless though, if you had invested in this 8 years ago with just $10,000, today you would have $1.4 billion. I know that's a bit insane to think about, but I feel like this strategy is worth looking at to see what it's doing really well. And the last strategy is one that I just put together this morning, and it's actually a better buy the dip Nasdaq. And if you're not familiar with buy the dip Nasdaq, it was actually showcased in the very first video of this channel. So if you want to learn that, go ahead and watch Beating the SPY. And what makes this strategy really good is it has the sort functions that we were designing in the previous episode, which was called Using Fundamentals to Beat the Stock Market. If you haven't seen that episode, go watch that because it'll help you understand this episode. Now, this strategy has an 88% annualized return with only a 36% max drawdown. Finally, after we go through all 3 of these strategies, we're going to discuss creating a hybrid or Frankenstein strategy, combining the best attributes of each one to hopefully make a strategy that is better than all of them. So let's get started with Claude Constantine's SPY Minimum Drawdown. I actually reached out to Claude on the Composer Slack channel, and hopefully I can get him on one of these episodes to discuss a little bit about his design and thought process on this strategy, but he's currently on vacation for a while, but hopefully he'll get back to me. So this strategy doesn't have anything crazy. It's not doing any kind of outsized returns on the stock market, but what is really great about it is this minimum drawdown right here, and this beta of only 0.5. Typically, when you're designing investing strategies that have extremely low drawdowns and are low betas, meaning beta, it means the correlation to the overall stock market. So if the stock market moves down 10%, a beta of 0.5 only gets roughly half of that movement. So it's only losing half of that. Now, you would think that with a beta of 0.5, that means you're only losing 50% of whatever the total loss is when the stock market moves down. But that also, you would think that means you're only going to get 50% of the upside movement. So you're only going to return half of what the stock market does. But in fact, this strategy has an annualized return of 11.6%, which is actually slightly better than the S&P 500. So we only lose 50% of when the stock market crashes, but we still actually beat by a small percentage the stock market when it's moving up. I think this strategy is absolutely beautiful, and I would love to sit down with Claude and talk to him about this a little bit. But let's walk through what's happening in this strategy. It looks complicated, but it's really not. So the strategy is broken up into weighted specifics. We've got 5 kind of sections here, and we're going to go through each one. The first one is the risk on, risk off. This is a very simple measurement of max drawdown. So anytime the stock market has less than a 5% drawdown, we run this risk on strategy, which is investing in SSO and TMF. We can see here on the chart that SSO is just the S&P 500 ETF, and then TMF is 20-year treasury bonds, but a 3x leverage position. Now, if the max drawdown of the SPY on the past 10 days is more than 5%, meaning we are on a decline, then we go risk off, and it looks like we're just investing in SHY, which is 1 to 3 year treasury bonds. They basically just go sideways and flat most of the time. GLD, which is gold, which is typically seen as an inverse to equities, and VTIP, which is short-term bonds that are inflation protected. They were designed and created in, I think, the 1980s, but essentially they're designed to kind of curb or calculate in inflation, and they typically do better than bonds when inflation is high, but they don't typically do as good when inflation is low. So that's the first section. That's just 30% of the portfolio. The next position of the portfolio is just a simple VOO. This is just the Vanguard S&P 500 ETF. We have 10% in here, and it's just kind of a flat anchor. The next one is 20% buy the dip Nasdaq. This is the strategy that we showcased in the first video. I also built a better version of the buy the dip Nasdaq, which we are going to take and probably exchange this section to see if we can get better returns. The next section is volatility hedge. This is just a simple weighted of UUP and SHI. SHI is short-term bonds. Now, Investico's UUP ETF is actually more of a Forex ETF, and it kind of compares the US dollar compared to the other major 6 currencies. I believe it's the euro, Japanese yen, British pound, Canadian dollar, Swiss franc, and the Swiss franc. And it's typically seen as a volatility or inverse protection against financial movements in the overall world market. And as you can see, UUP's been on a rip and run lately while the stock market has been going down. And if I turn on the S&P 500 overlay here, we can kind of see that we have an inverse relationship to the stock market. So when the stock market's coming down, UUP is usually going up, and then vice versa, but not always. And this is also correlated to other world currencies. Long story short, though, UUP is typically used as a protection against volatility in the stock market, and that's why he probably has an under volatility hedge. And lastly, we have the oil and bond hedge. And admittedly, I don't know a whole lot about oil commodities. I don't study oil a whole lot, but we have a 21-day cumulative return of DBO is greater than 0. So we're looking at oil, and we're saying, if its returns is greater than 0 over the past 21 days, then we're investing in oil. If that is not the case, we are then going to go defensive and invest in SHI and BSV, which are both short-term bonds. So that's the entire strategy. So real quick, I'm going to take the new version of the Buy the Dip Nasdaq that I built this morning. We're going to go ahead and delete the Buy the Dip inside of this strategy, and we're going to add our new one. And I just want to show you guys that there's a lot of room for improvement on this strategy. And this strategy, I think, is going to be a phenomenal backbone strategy for a lot of the stuff I'm going to build in the future. I just love that this thing has an extremely low drawdown and low beta, and that's a great position to start with most of the strategies you design. So I went ahead and threw that in there, and we're just going to run this real quick, and I'm going to add the Symphony just to compare it. SPY minimum drawdown. We're going to add this on here, and we're going to compare this new version to the old version. And if you want to see how I built this sort function, go ahead and watch the previous episode, Beating the S&P Using Fundamentals. And as you can see, we've got much better returns just by switching out that one little function. And if we come down here, we actually have a beta. Our beta's gone up just a little bit, but we have much higher outside. We've almost doubled our APY to 25%, and our max drawdown is still 13.7%, which is phenomenal. So yeah, I really love this strategy, Claude, if you see this video, and I would love to have you on here and talk about it a bit more. I think it is a great backbone for any strategy or anything that somebody's trying to build when it comes to these auto investing strategies. Now, this next strategy is insane. $1.4 billion, 293% annualized return, extremely high deviation, 70%, extremely high max drawdown, extremely high Calmer ratio of 6.36. It's just insane. And if we go back before COVID, it still did amazing before COVID during the bull run. And then when COVID happened, we get a little bit of a downtick, but then it just rips up and just keeps climbing all the way here. And if we slide forward to about COVID crash, even if we reduce the COVID crash, we still just have an crazy insane gains, and this thing just seems like it doesn't stop moving up. So let's take a look at what's happening in this strategy and kind of try to understand what's going on. And as you can see, it looks a bit complicated, so I might draw this out visually so it's a bit easier to understand in my Miro board. All right, after 2 to 3 hours of trying to wrap my head around this strategy, and I've mapped it out completely visually, I'm going to walk you through how this thing works. And it's basically a bunch of mean reversion strategies. And if you don't know what that means, 2 episodes ago I explained it, but I'll explain it again real quickly. If we go over to the S&P 500, you'll notice that I have down here RSI, and this is a 10-day RSI. And if you'll notice, there's a lot of 10-day RSIs happening in this strategy. And a mean reversion strategy, essentially, the theory of a mean reversion is a stock or a market will move in a average place range of position, and if it overextends that position or that range, it's going to snap back. And a mean reversion strategy essentially capitalizes and profits off of those overextensions on the high side or overextensions on the low side. And let me show you how that works visually on this chart. So mean reversion strategies, typically you can see here, whenever the RSI on the S&P 500 gets above 70, we have this snap back. And if you scroll in here, you can see, Like for example, right here, we have an RSI of about 85 on the stock market, and then we have these red days, and it's coming down. So essentially what a mean reversion strategy says is when we are overextended on the high side, we actually want to take a short position here. So when the market's overextended on the high RSI, we take a short position, and then when we are underextended on the low position, you actually want to take a long, like a leveraged, like a 3x leveraged long position in the strategy. So I hope that makes sense with mean reversion. Mean reversion strategies are much better, and this is how you typically outperform the overall stock market, by profiting off of the inefficiencies or indifference of the prices. So if the average price movement is here, but the current price is here, we buy a long position to profit on the return or the difference in the average. And the same thing goes for the top. If this is the average and this is where we're currently at price wise, there's a high chance that we will mean reversion back into the middle. So you're taking a short position on the high side. Okay, and then lastly, I'm going to show you a legend real quick. So I've got a few symbols here. If you see a pink box, that is RSI. So we have a 10-day RSI here. If you see red triangle, that is a short position, or we're taking a short position on the stock market, and a long position will be green. And then also I have a compare boxes. So like this is a price versus the 200-day move average. The 200-day move average is this yellow line. So when the price is above the 200-day, we are going bullish, and then when it is below the 200-day, we are bearish. Now, lastly, I have two arrows. We've got mean reversion arrow and normal position arrow. I've already explained to you what mean reversion is, but know that when you see a dotted arrow, that essentially means we're taking a mean reversion position, or it's strategized to be a mean reversion. Then lastly, the overall strategy has three sections. We've got a bull market strategy, we have a normal market strategy, and then we have a black swan strategy. If you're not familiar with what a black swan is, just go Google it. But a black swan is like the housing market crash, 1987 Black Monday. COVID was a black swan event. Anytime the market has extreme fear and panic come into the market from unexpected, unforeseen situations in the world, we have massive crashes. So let's get started. I know that's a lot of prefacing, but all right, first thing we're looking at is price to S&P 500 200-day move average. This is looking at the S&P 500, just the overall stock market, and we are looking at this area right here. So the first part of the strategy we're going to look at is this section, which is the bullish side. So when the market is above the 200, this is what happens. So the first thing we're going to look at is the 10-day RSI of Tttq. Tttq is a 3x leverage position of tech, which is QQQ, so the tech sector. So we're going to open up the 200-day move average. The next one is the 10-day relative strength. And if it's above 79, we're going to take a short position on UVXY. And you can see that here, above 79, we take a short position on the UVXY. So this is a mean reversion. We are essentially saying the tech sector is overextended and it's going to snap back. So we buy UVXY. Now, if it's below 79, then we move on to another mean reversion RSI check, and this is XPXL. XPXL is a 3x position of the overall stock market, or the S&P 500. If the overall stock market is above a 80 RSI, we take another short position on UVXY mean reversion. But if it's not, and it's below 80 RSI, then we're just taking a flat position on TQQQ, which is a leveraged position right here. And I already see immediately something I can do to improve this strategy and make it more better. So we're going to delete this, and I'm actually going to go over to a better by the dip Nasdaq strategy, which I'm going to be showing you after this one. And we're just going to copy this, and I'm going to place it right here instead of buying the TQQQ, and this should get us better profits. We were at $1.4 billion. I think this should do more. Yep, we're now at $1.5 billion. And looking at the numbers, we've reduced the max drawdown to 33%. So let me undo that real quick, and let's redo the symphony. I believe the max drawdown was 47%. Yeah, so 46%. We dropped that max drawdown to 33%, which is just as good as the overall stock market. And looking at the other numbers, we now have a 298% annualized return, an alpha of 1.55, and actually a negative beta by 0.01, which means that this strategy does not care what the stock market's doing. So phenomenal. Calmer ratio of 8.98. We're almost to a 9 calmer. I wonder if we can get to a 10. So that is the bullish strategy. I'm going to go ahead and just minimize all this. And now we're getting into the next part of the strategy. And this is where it kind of starts to get complicated. So the first thing we're looking at is the 10-day RSI on the TQQQ, which is the bullish tech sector 3x strategy. And we're looking at this, and we're looking at the RSI. So if the RSI in tech is below, I believe, 31, which is right here, yeah, below 31, we are buying T-cell, which is a 3x position on the tech sector. So we're doing a mean reversion. So we're essentially, when it's down here, we are buying a long position and essentially buying the dip on tech. Now, if we're above 31, then we go to another RSI check, which is checking the S&P 500. And if the S&P 500 10-day RSI is below 31, we are buying a 3x version of SPXL long position on the stock market. So we got 2 mean reversion checks before we get into the short strategy. And also, just to reiterate, we are also now below the 200-day move average on the S&P 500. So if the overall stock market, so going over to the overall stock market, we are no longer in the bullish version, we are now in this area. So we're either looking at these sections of the market. And these are different. So this one is the black swan of COVID, and then this one is just a slow stagflation decline of GDP and decline of growth in the economy. And you'll see that as we move into the strategy. So next we are looking at 10-day RSI of UVXY. And this is where we differentiate the black swan. So this is the black swan checker. If we are above 75 or 74 on this, we go into a black swan strategy, which we will be looking at. We will be looking at this part of the strategy in this section of the stock market. But for now, we are going to look at this. So we're going to go up to here to the normal bear market, which we are currently in, and that is if the RSI of UVXY is below 74. And just to show you what UVXY is, if you don't know, it is a volatility ETF that tracks VIXY, which is the volatility index of the overall stock market. So this is VIX, and this is essentially the inverse of this US stock market. VIX goes bullish when the stock market crashes. As you can see right here, this is the COVID collapse. And let me delete my drawings just to make it a bit, well, actually I'll leave those up so that you can see that the mean average of volatility. So whenever markets crash super hard, we have massive spikes in volatility, and you can see over here, this is the 08 housing market crash. So we have these massive rips in war whenever fear comes into the market. It's really a measurement of fear. Now, UVXY is a ETF that tracks that. Now, you might see that it decays over time, and that's because it's a leveraged ETF that it just naturally decays, but we have these massive run-ups. And if we see the RSI here, we're above 74. So this procs whenever the market is crashing and we're in this black swan event. But actually, we're not in that event right now because over the past couple of months, we have not even touched close to the 74. So this is natural bear market movements in the stock market. Okay, so the next part of the strategy, we are looking at the normal bear market. So we're looking first at the price versus the 200 move average. And if we go over here, the 200 move average is this white line. So when the price is below the white line, then we are going to go to a sort function. And when we are above the white line, we're going to be running something else. So first, this is the section of the strategy that we're looking at. And we're going to go ahead and look at the part that is above the 20-day move average. So we're looking at this section right here, and I'm actually going to add another chart down here at the bottom. And this part of the strategy looks at the RSI of the SQQQ. So if we put the SQQQ at the top of this chart, here's what we're going to look at. So as you can see, the bottom here, I've got the TQQQ. So we're checking the 20 move average versus the price, and the sections that we're going to be looking at is right here. So we're looking at this section of the TQQQ bullish, but we're looking at the RSI of this section. So let me continue to draw all these lines real quick. And we're going to be looking at these two sections right here. So what this strategy does is if the RSI on the QQQ is above 31, we go long on TTQQ. So in this area on the RSI, we are going long. And if we look over here, you can see that we should be going long because this is the section that is going long. But if we are below the 31, we actually take SQQQ here, and we can see that we proc it a few times down here where we're taking SQQ short, and that's essentially a mean reversion. So actually, this should be a dotted line as a mean reversion strategy for SQQQ. So that's that side of the section. Now let's look at the opposite side of the normal bear market. And we are going to look at this sort function, which is 10-day relative strength index versus SQQ versus BSV. So if we go back to the TTQQ, we're no longer looking at this section. We are now looking at this section. So we're now going short. And this strategy is pretty simple. It just sorts between top RSI. So unfortunately, I can't add a RSI comparing tool. There might be one out there, but I'm not familiar with it. Actually, let me see if I can do that real quick. Okay, I actually figured it out. So we're looking at the SQQQ real quick, and we're looking at these two green sections. And I found this indicator called RSI compare. So if you just type in RSI compare, this one right here, really good. And I set the details to this if you want to copy it. So the first one's SQQQ and then BSV. The green line here is the SQQQ, and then the red line is BSV, which is bonds. And essentially, this sort function buys whichever one is the top RSI. So whichever one has the highest RSI, it buys it. And this is actually a genius. I applaud you, Derek, for this. I'm going to start using this. This is a very smart way to do this. But here's how this works. So here we can see that it's buying from here. Let me mark it out so it's a little bit easier. From here to here, we are buying short on SQQQ. And we can see that we're capturing this profit right here. So that's an interesting way to do that. But yeah, that's how that strategy works. And if you want to test that out and look at it, we also it triggers here a little bit, and it flips more back and forth. But then, especially right here, we are buying the short position of SQQQ because bonds RSI is lower. So yeah, that is the normal bear market. And that's a very interesting way to do that sort function. I'm going to mess with that more. But now let's take a look at the black swan. So this is looking at, we're going to go back to the 10-day RSI of UVXY is above 74. So that is going to take us to the COVID collapse, and we're looking at the 10-day RSI of UVXY. So if we go to UVXY and we go back to COVID, and I'm going to get rid of the compare thing, we're back to this area. And if let's start with the below. So if we're below 84, so if we're in between 74 and 84, we're going to buy UVXY short. So I'm going to go over to our RSI, and I'm going to change these lines to upper band of 74, and then we're going to do another one at 84. So right here. So if we're in this range, we're going to buy UVXY short. And if we draw that out, you can see that we start purchasing UVXY here, and we stop purchasing it here. But in between these days, you can see this day right here, we're actually above 84, and it looks like we probably take a short position on those days, and it looks like we might proc it as well a little bit here intraday. I think this might be, this strategy might worry me a bit. There's something called fitting a strategy too much, and you're trying to like maximize every little specific thing for the situation that's at hand. Not saying that this won't perform exceptionally well in the future, but overfitting a strategy can be a bad thing. Not necessarily. Well, we'll see. Only time will tell. There's no way, because nobody has a crystal ball, but this looks a little bit overfitted. Above 84 UVXY, we are going to go to the 200 move average of TTQ. So we're going back to TTQQ, and let me mark these days. So 24th February, 19th of March. Okay, so this is the part of the strategy we're looking at, but we're actually only looking at this section here because the 200-day move average of the S&P 500 we haven't dropped below the 200-day move average. Actually, let me double check that real quick. So we crossed the 200-day move average February 28th. So right here, the US stock market drops below the 200 on the 28th. So in this area, this is what we're looking at. So if we go back to the strategy, so this is the part of the strategy we are looking at. If UVXY is above 84, we're in this area. So if it's above 84 and the price of the 200-day move average of TQQQ, if it's below, we're going back to the sort function. So we have this sort function here, and if it's below the 200-day move average, we are going on the short position for SQQQ and BSV. So yeah, we're below the 20-day on this, so we're going short. Now, that's pretty much the entire strategy. I don't think it continues to go back, but it does move forward if we are above bullish. So if we go above the 20-day, okay, so I actually found an error in that strategy. I went ahead and deleted that strat. So this is what it did look like. So we had this 10-day relative strength index. We actually don't need that. In fact, we can probably delete all of this. So I'm going to delete this, and I'm just going to paste in and simplify that strategy, and we should still get the same returns of $1.5 billion. Just to simplify. Yeah, so it didn't change the strategy at all. But yeah, I went ahead and simplified that just a little bit. So we're actually going to take out all of this section and go to there. So that's the black swan strategy now. So that's a bit simpler. But yeah, that is that strategy. I know that was a little bit long. It's a bit of a complicated strategy. We simplified it a little bit and made it better, but nevertheless, it's a phenomenal strategy, and I'm definitely going to be messing with that a lot more. And I like that sort function between RSI on SQQ and bonds. So I'm going to mess with that and experiment with it. But the last thing we're going to look at in this last strategy is one that I built called the Better Buy the Dip Nasdaq. And if you're not familiar with the Buy the Dip Nasdaq, you can actually go to the Discover page on Composer, and it should be there. And it's just a very simple strategy. It's right here, Buy the Dip Nasdaq annualized. And all it does is it's a mean reversion strategy over a 5-day cumulative returns, and it just buys between TTQ and BSV. I went ahead and improved it quite a little bit. So we're going to look at the first part of the strategy. It's very similar to the original. 5-day cumulative return QQQ is less than 6. So we're looking at the stock market moving, or the QQQ moving down over 6% or more over a 5-day period, which is a pretty rapid movement. And then if the 1-day return is greater than 5%, so we have this massive snap back, it's going to buy a short position on QQQ or SQQQ. And if it's not regained 5%, we're going to take a short position, and we're essentially doing a mean reversion on TTQQ. So we're taking short if it's TTQ, and we're buying the dip if it's below 31. So that's the bullish side. Well, I guess that's the bullish side. Then we have another mean reversion, which is essentially the same thing. Relative strength index of QQQ is overextended. We take a short position on QQQ, and if then we check the 10-day strength index of QQQ is above 30, we're buying the dip on QQQ. But if the market's just running normally, we go into a better QQQ, which is a strategy I built in the last video. If you want to see that, look up using fundamentals to beat the stock market, and I will show you that strategy. All it is a sort function between the top companies in RSI, and we're buying the bottom 4, so we're actually buying the dip. And this strategy has really good returns for being very simple. So it's a simple mean reversion strategy that also buys the dip. We got 4 million returns, annualized return of 100%, max drawdown of 33, beta of 0.76, and an alpha of 0.68. Okay, so the last thing I want to talk about is combining all of these strategies into kind of making a Frankenstein. So I already showed that we could improve the minimum drawdown just by changing around the dip buying strategy here. So we got outsized returns on this, but I think we can take this volatility hedge here. I think we can take that and change it to profit off of this insane TTQQ one. So I want to take the best parts of each strategy. I want to take the TTQQ and apply it into this SPY minimum drawdown to essentially profit off the short side. And then I want to take my buy the dip Nasdaq to essentially create, you know, a super strategy. We're going to combine, I'll do this in the next video, but we're going to take all three of these and try to make something that's got extremely low drawdown, extremely high profitability, extremely low beta, and just basically can't lose. You never want to say that on an investment strategy, but yeah, hope you guys enjoyed this video. Hope you learned a lot. I know it got pretty technical and I had to run through a lot of this stuff pretty fast, but I didn't want this video to be like an hour and a half long. But nevertheless, if you like this video, go ahead and like and comment, and please share this video because my videos are getting flagged or something and I can't advertise them. And if you have any questions, hit me up on Instagram. I'm also in the Slack channel for Composer. And for Claude and Derek, if you're watching this, I would love to sit down with you guys and talk a little bit more about the thought processes and stuff behind your strategies and see if we can create something even better afterwards.